Hi, Mark Oswald hosting another segment of Londonderry Heart, Home, and Soul. How's your credit? We've got two experts here today. To my immediate right is J.J. Sawicki, who is an Assistant Vice President with Merrimack Mortgage. Welcome back.
Thanks.
And Nellie Dowdy, who is a loan officer with Merrimack Mortgage. Thank you, ladies.
Thank you.
Let's start, Nellie, first with you and talk about the difference between a pre-qualification and a pre-approval for a buyer.
Well, a pre-qualification is relying on me to tell somebody they're credit worthy. It's kind of like the paper it's written on. I can look at a borrower's credit, I can go over their information, their income, and it's all based on verbal. There isn't documentation, and it's not looked at by an underwriter. So that's a pre-qualification. I can give them an idea of, based on what they're telling me, they would be qualified to purchase that. The things that vary with that is that a lot of times the borrower will come in and think that they make a lot of money, and they'll tell me, I make $5,000 a month. And then when it gets into an official pre-approval process, which is actually taking those documents and bringing them in and submitting them as a loan, the only thing that's missing is the property, and an underwriter will look at it and say, well, yes, last year he made $5,000, but $2,500 of that per month was overtime. And it's so it varies. And in order to really qualify a borrower and approve a borrower, everything according to their assets, their income, their employment, their credit, all needs to be looked at by an underwriter with documentation. With a pre-approval, they're able to come to you as a ready, willing, and able buyer,
Right.
and be pretty much first in line, ready to go, just find a property.
And those that earn a sales commission would also be impacted.
They would.
It's not
they
a
would.
guarantee.
They would. If the income is above and beyond what would normally be a base salary, many people are paid a base salary plus
Right.
commission,
Right.
or they're paid a base salary and then they receive overtime or a shift differential. All of those additional incomes and funds need to be averaged over a 2-year period with the probability of continuing. And so there's an actual written verification once it comes in for pre-approval that's sent out to the employer to verify the breakdown. That
Right.
also applies to like a bonus. So same thing, same thing.
And from my perspective as a realtor, I know that many times buyers are anxious, particularly first-time buyers. All that energy and enthusiasm, all that excitement about their first home, and yet they suffer sometimes from ready, fire, aim.
Yes.
And without that pre-qualification, they may be overshooting the mark. They're looking at a house well beyond their means.
They can. Yes, excuse me, they can. And they don't mean to. They think that they're making all of this great money, and that's what it is. But when it actually gets underwritten, and most times it is, and on the initial meeting that I would have with them, I would ask those questions. The loan officer would ask those questions. You know, is this all salary? Is this overtime? Is this? And they'll tell us. And when that's the case, especially when we know overtime, bonus, or commission is involved, you really, really want to get them in for a pre-approval so that we can know
Right.
with certainty what they would qualify for and that they were approved.
And I always encourage that because they can go forward with the process with a lot more confidence.
And so can you.
And that they're not house poor.
Yep.
So they
Yep.
can maybe afford X amount.
Yep.
And then if the car dies or the refrigerator quits working, then
Right.
they literally don't have the funds.
Exactly.
And that's really one of the first things that a realtor is going to be looking for, a real estate agent is going to be looking for. If they have a home buyer that's coming to them, they're going to be asking if that borrower has been pre-approved. Because the real estate agent knows the value of a pre-approval letter. But like Nellie said, a pre-qual letter is really worth the paper it's written on. It's really not a great value to an agent.
And I think increasingly as we've come into a selling market, a lot of sellers are anxious about the capability
Yep.
or the qualifications of a buyer.
Yes.
So they're expecting that. Many times it's the norm now to accompany a purchase and sale, an offer on the property, with that letter.
Yes.
Absolutely.
So a lot of what goes into that, JJ, would be credit.
That's correct.
So let's talk about the importance of credit and what's considered good credit,
Okay.
and If it's not, how do you improve it?
Okay. Well, there's a couple of things to consider. I mean, in the most basic way that I can put it, really anything below a 620 FICO score is not necessarily a good score. It may be more difficult for a home buyer or a homeowner to get a mortgage with a score that low or get a good rate. Really, anything with a 720 or higher is typically considered a good score. It's considered a lower risk loan to a lender based on that one fact alone.
And how do you determine a credit score?
So there's a couple of different ways. There's a lot of providers out there, especially the ones online, where you can monitor your credit. You pay a monthly fee, that kind of thing, and they'll email you with credit alerts, credit updates, things like that, and they'll provide you with a score. That score isn't necessarily going to be the score that the mortgage lender is going to use. A mortgage lender pulls a mortgage credit report. That mortgage credit report is based on a completely different algorithm than the algorithms that the providers on these websites use. Very, very different. So the chances of your score being different is going to be about 100%. So what the mortgage credit report looks for is it looks for really all of the information that a lender would need to make a credit decision on that loan.
So in other words, don't believe everything you see on the internet.
No, not at all.
Okay.
No.
And what are some cautionary things that people should look at? I mean, if you're applying, is it a good time to improve your credit score by applying for a credit card or not?
There are a couple of different things that go into, improving your credit score. Applying for a new credit card right away probably will not help you.
Mm-hmm.
It's probably going to actually hurt your credit score. Typically, what happens is you take a hit to your credit score based on each inquiry, and that's assessed a number of points. It's typically about 15 points. And that stays on there for about 90 days. So a lot of the things that do come up, as we're going through the mortgage process is we're evaluating your credit through the entire process of the loan, right? When you have a first-time home buyer or a regular home buyer, refinancing, whatever they want to do, we have a lot of people that will go out and they'll get credit cards because they want to buy things for their new home. They want to get a Home Depot credit card so they can buy their new dishwasher or stove or whatever. When you do that prior to closing on the loan, it may impact your qualifying. If your payment goes up, throws your ratios out of whack, which can affect your real ability to repay. So it can change your loan from an approval to a denial like that.
Another thing that happens, just to add to that, is that people come in and they have just enough knowledge just from what they've heard online or what they've read, and they'll go through and they'll start, okay, these credit cards need to be closed, or I've got too many open accounts, or I've got even sometimes collections. Ultimately, yes, we're going to sit with them and we're going to say, they still may qualify even with a collection.
Right.
But even with paying off a collection right before applying for a loan, even though you intend to, it can actually harm your credit score because closing accounts, reducing your available credit, and even consolidating one card, consolidating cards and getting rid of one account. Those are all things that actually can hurt your credit because your profile has been established based on what it is at a picture, at that snapshot. So there's a lot of misinformation out there about that. They're like, well, what do you mean? I closed all these accounts, I paid down this loan. Also, one thing that people don't realize is that it's the variety of credit.
Right.
I've had clients that have said, well, why would my credit score drop? And it's because they paid off a mortgage 6 months ago and they no longer have a mortgage that's reflected in their credit profile. So it doesn't help to maintain that higher credit score.
So let's take the other extreme, if you will. You've got a young person that's recently out of college, and they don't have any established credit.
Yep.
Yeah,
So how do they build or establish credit so that they can purchase?
There's a couple of ways to look at that. So if you have someone that's really just trying to build traditional credit, they're trying to build traditional credit, they're trying to obtain a credit score, which some people don't have. So typically what any lender would be looking for is they'd be looking for a borrower to have at least 3 traditional trade lines, so trade lines that show up on a credit report with a 12-month history with no lates, okay? So, and as long as you have 1 score, then you're fine, you're good to go. There are some other programs that will allow for completely alternative credit. Now, alternative credit would be things like utilities, daycare, cell phone, things like that. And those are items that are not traditional credit, so they don't show up on your credit report and they don't generate a score. So in those cases, in those programs, you again would show 3 alternative credit references with a 12-month history that have no lates. And you do that via bank statements, canceled checks, things like that.
Yep.
What's the biggest misconception among potential buyers with credit? What do they overlook?
What do they overlook? I think Nellie made a really good point as to the closing of accounts. I mean, I guess logically you would think if you close an account, you know, you pay off an account, you close it, you're good to go. It's good for your credit. It's not. It's actually harmful to your credit. 35% of what goes into making your score is capacity. So if you have a credit card with a $2,000 limit, you pay it off and close it, now you're lacking that $2,000 capacity. So that's a pretty major thing.
Okay.
Yeah. Normally, you know, when you meet with people, you just kind of, you tell them what the standards are, you know, what the minimum requirements are, and you let them know, and they're actually, once the credit is pulled by us, we're able to direct them to get a copy themselves, to look at it and to review it and to do the work on it,
Yeah.
if it's needed.
There's a couple of items too that potential home buyers should be aware of. As Nellie said, you know, paying off collections. In some cases, yes, you're going to have to pay off collections. But there are other items that as a lender we look at very, very carefully and will always require that they're paid off because they could potentially affect our lien position. So things like judgments, tax liens, things like that. If they've had a previous bankruptcy, certain products require certain time periods have passed since the discharge of a bankruptcy, which sometimes can take a long time. Same thing with foreclosures. We're going to look at that as well. And you know, a certain time period has to have passed since the foreclosure.
The good news, I think, in working with your organization, I found this to be true. If someone isn't credit worthy, you're providing counseling and suggestions and helpful tips, if you will.
Well, we're not credit counselors.
Right.
We really can't act as a credit counselor because we're a lender, but
Yep.
we can inform them as to what's there, what we're
Exactly.
seeing, and guide them to where they could possibly get some help with that. But
Yeah, we work with a couple different credit providers out there that have some pretty savvy systems when it comes to what needs to be done in order to potentially, you know, get your score to X. So, and they can also help potential borrowers with information that may be inaccurate on their credit report, or things that have been paid off that that don't reflect correctly today.
Is it fair to say that most credit scores are like snowflakes, no two are alike? I mean,
Yes.
from one individual to the next, there's going to be a number of circumstances, differences that need to be addressed.
Every single borrower's credit profile is going to be different. There is not one that's alike. So yes, like snowflakes, right? You know, you may have a borrower who's got the same credit score as another borrower, but their spending habits are completely different. And that again goes back to the algorithms that are used to generate a credit score.
Terrific. Thank you both.
Thank you very much.
Our next segment, we'll be back in a moment, will be about types of financing.
great.
So until then, thanks for watching.